Okay, what's going on? What's going on? Good evening. Today is Wednesday, October 29th, 2025. And what this video is going to be about is our New York Open entry that we took, just kind of recapping how that worked out. And then just overall how to play FOMC. So I've played a lot of FOMCs now. I'd have to look back into how many I actually have tracked. But there is a specific way that you can play it. There's certain things you want to understand that I may not be able to fit all in one video. But a lot of it comes down to timing, right? They like to, what I call is stagnate the price until the release, because what you're seeing is a player versus player environment. So you're going to be seeing, buyers and sellers and individuals that are just kind of on the fence and, different things that go into these markets that are going to be having different positions, do different things. And so this is just to kind of help you guys, especially if you're trading futures, but I'm going to specifically talk about NQ and MNQ is what I ended up trading today. And just some little tips and tricks that I think, can really help you increase your edge and also help you from not blowing accounts, right? Because you're not always going to have the best day on FOMC, but you can also have a really, really crazy day if you play it the right way. So I'm gonna go ahead and jump into the charts. Like I said, first what we'll do is we'll start off with going over New York, and then we'll go over the second half of the day FOMC. Now, I am going to talk a little bit about supply demand, right? When it comes to the Wyckoff method, understanding certain key timing things, like I said, like MOC at the end of the day, why it's important, what you're waiting for to see in that situation. And I'm also going to kind of go over like what the ICT retail trader sees, okay? Because I also spend a lot of time studying other traders. These are kind of like what some of my notes look like throughout a day in, day out basis, right? So this is kind of like what I write out in price every day. And so, um, yeah, there's going to be some nuances of things that we find out. So let's go ahead and dive into this and get it started. Okay, so one of the things that I want to talk about is, let me pull this up here. And these images, some of these you can find online, right? Or if you are in my Telegram, I'm sure I've put it in there before, it shows us to surf through the files. But one of the main things that you want to focus on is the market moves in four phases, right? So a lot of times the market's going to do four different things, right? And these are what I pretty much look at as those things, okay? So I'm going to bring over another window here, bring over just 1 hour here, bring that picture back up here really quick. Okay, so the market's going to move in four phases. So if you look at the Wyckoff phase here, right, you can kind of see from the market open, right, we had bought up all of Sunday and Monday, and then this is the open of Tuesday, and then all the way into Tuesday into today's open, which is Wednesday. And we coming into this market today, it's safe to say if you really look at this diagram, right, are we oversold or overbought? Right. And at this point, in my eyes, before New York even opened and we extended up, and like I said, I'll go over, we were really overbought. We've been overbought, I would say, since we've made all-time highs here. Okay. So we've been, ever since we crushed through this level here, 25,400s, right? Essentially, we've just been in uncharted territory, just marking up price and just going crazy. Okay. And so this is all more of like a top-down analysis, confluence of understanding and supply demand, right? And just understanding where orders are going to come in and where orders are going to be taken out. So that's the number one step, understanding, where you're at in the cycle of things and what to expect in an oversold market and an overbought market. Okay. And so now when you go into the New York Open, this is what you would have seen. And I'm going to show this from a smaller time frame perspective here as well. So we'll do 15 and 5. We'll just kind of put them all here at the end. Okay, so this is what we pretty much were looking at when we came into that New York Open. And so I'm going to move this just for the, this is just the breakdown the end of the day here. But this is what we were seeing when we were coming into New York. So I'll show it from a 15-minute perspective. All right, you only could see, so that before 9 a.m. happened, right? So this would have been just like this. So we were anticipating a push up at New York that was going to take the all-time highs, and I was anticipating price to go up to 26,350 and possibly even 26,400s. And then as we got into the news time, start to see some capitulation, which we ended up seeing. Now, one thing about FOMC you want to know is they're going to stagnate the price, right? So what that means is they're going to basically draw it out until around that 1 p.m. Release, and as well when Jerome Powell starts to speak, right? So you want to know that when that came out today at 1 p.m., they released the rate, right? We went down a quarter percent, and then he doesn't speak to 1:30. Now, most players don't really start making too many moves until he starts to speak, right? So by this time, most people have already just destroyed themselves, okay? Now, New York Open, I'll kind of go over that order briefly and kind of show what we ended up doing, and I posted that in the Telegram chats, is we had a 15-5 setup that looked pretty good. That first 5 minutes, as you can see here, of New York, right? First 5 minutes in New York, we had a sign of strength, so at 8:30 to 8:35, and then we've seen price come back and test down into the 15-minute demand, right? In this area here, so where my eyes are focused when I'm saying this is right here. All right, so I'm gonna make this a different color just so it's not the same. And so we've seen price testing into there, creating edge for us to play up to the all-time highs, right? So I was looking at something like this. New York opened, it swept down, swept some old lows, came into this area. I had my edge pretty much marked as here. I had about a 15 handle risk, and I was looking for a break of structure of the 26,300s for a 1 to 3 setup, okay? And so getting right above there was pretty good, but what we really wanted was just price to make a new all-time high, which as you can see here, right, put us at a 1 to 3 R, which was a good setup. That's where we started. Had 2 contracts on that. As soon as price delivered, and then the 8:55 to 9 candle was the one that blasted through. We had one take profit set right in that area, and then the other we moved to break even right after that, and then shortly after, going into like 9:45, 10 a.m., they came back for the remainder of that order. Okay. Now, from this point right here, there's a lot of waiting and sitting, okay, until you get to that news release. Now, as you can see here, if I go back to replay mode as well, right, before the 1 p.m. or before the 1:30, what they did was they made it a liquidity pool, which was really nice because if you go through and you look at the day, right, they're gonna, like I said, they're gonna drag people out all throughout here. So like when you're looking at price between 8:30 and about 11:15, that's usually when people get weak-handed, they get tired, they start going on tilt, they start making like crazy decisions, right? Not realizing that they still have about 2 hours before the actual release. So if you look at from 10 a.m., which would have been here, to this candle here, which was 1:30, right? Let's go to actually just one here, right? This is about where people were just playing in between a range, right? There's really nothing happening, like true price action that I believe that's like worthy of what we usually see on a day in, day out basis. And so you don't want to get trapped in this. But one thing that I really like to play, and this could be on any given, setup, is a capitulation bounce play. And what a capitulation bounce play looks like is going to be like this. I just want to kind of explain it over here as well. Very similar to, matter of fact, what you're seeing right here, right? And so how it actually looks is you'll have price, essentially do what it did here, right? Just kind of goes sideways, like does this, right? Doesn't really make any more highs, doesn't really make any lows, and then you get a massive fallout, right? So just like the 130 candle, right? Now, what most people do and what retail traders do is as price breaks through these levels, they're what's called breakout traders. And what they do is they don't understand what high and what low is in the marketplace. So what they end up doing when price falls to these levels that we were looking for, which we were looking for liquidity levels here, right? We were looking for 26,100s, and we were looking for possibly that 26,050, and I'll explain why when it comes to supply demand on the H1. But what most people do when it breaks through a level like this, they actually go in and press the sell button at the wrong spot. Now, if you've traded for a little while, or maybe you're new to trading, the concepts of trading are buy low and sell high, right? So essentially what you want to be doing is if you're going to sell a position, you want to be selling high, right? You don't want to be selling low. Does that make sense, right? So a lot of people, when these type of moves happen, one, because they've been uh, sitting in so much consolidation, essentially, their nerves and their tilt is getting ready to go crazy. Okay. And so what you're looking for is you're looking for higher time frame supply and demand. Now, what does that mean? When a price sells off, a lot of the times when it sells off, there's going to be a candle, right, on like a higher time frame, like a 1 hour, right? That's going to be a demand candle. So like for example, when price comes into this candle right here today on the H1, right? Capitulation here at 130. So let me highlight that really quick. All right, so we've already seen the consolidation area. Now we're just focusing our eyes on the 130 release here, okay? Now what I want you to do is always be looking left, because one of the hard things about playing at all-time highs when you're looking for positions to go higher is there's really no price to look left to see, okay? And so in this situation here, we had a massive capitulation at that news release, which freaks people out, but this is like my favorite type of play. Now, where did it sell into, guys? That demand candle, right? This is exactly what you want to see on a higher time frame. So if you're looking at, maybe one window, it may be hard to see, but if you have at least two windows, I think it's pretty, easy to see what it is. And so price comes down, taps the area. Now, here's what you're seeing happen, okay? Because this move is so fast at that 130, right? And let's think about this, right? If you end up having a sell and you were holding this and you come on at 130 and you see price down in a 15-minute bar, almost 200 handles, what do you think's happening? Like what has to happen for those shorts to exit the market? It's kind of like what we talked about yesterday. Well, buy limits have to be filling somewhere, okay? And so inside demand, this is why I say you really want to focus on supply demand, because you're not only using it to enter orders, but you're also using it to gauge where an individual is going to exit an order. Okay. And so comes under the no wick area, comes right into demand. Your thought process is if people are up 200 plus handles, they're either trailing their risk down. Most of them, I would say, got in at the breakout and they just kind of sold very aggressively at that halfway mark. And then, they're getting out super quick. So why do you see this capitulation bounce play work out? Is because, like I said, you're going to see the buy limits fill in this area when these people are trying to get out of the 200 plus point short. Now, as well, what happened at New York was very important, okay? Because what happened at New York is we had bought that position up, but what did that leave behind, right? That left behind short liquidity, right? So they had the all-time highs, the New York high, right? And then price started to break down, crown form, FU candle, right, through the area. And then a lot of individuals, I would say, probably started to sell more in here, right? Like right in this area here, trying to sell down. It manipulated them before the release, right here at around like 1 o'clock, like about 30 minutes before, coming in and testing where. Now, this is where you have to get a little bit more understanding and experience with the markets, but you got to understand where the supply demand is and then what's high and what's low. So for me, what I could tell in this situation was that the New York shorts still had liquidity that was resting at the high of day, which is usually a target for us. But when they tested, before they even did this drop, they tested this area right here. But where'd they test in? I just kind of want to show this again. Inside a supply candle, right? Because essentially this run up here becomes supplied on the 1 hour and on the 15. So why aren't they able to close bodies above New York, right? Because they're getting ready to drop that price down to those lower liquidity levels and to the normal point of interest target, daily open, and then to that higher time frame, like we talked about, demand. Okay. And so that's what I was seeing going into that. Now, now I'm going to go over how do you actually catch the capitulation bounce play inside the demand? Like, what do you want to look for? Okay. And so when you go and you look at that, we're going to go and look at um, we'll look at a 5 and 1 minute here, right? Because you have to be able to see this happening on higher time frame context, but have the understanding of what you're trying to see happen and still be thinking in probabilities, still be thinking with edge, right? You don't want to wait until price gets to MOC, right? This is 12 or 245 into 250 and 250 opens right here. So this is MOC right here. This is way too late, guys, right? If you're trying to enter a move right by the news opening price, but you also got to realize that you're so late on the trade if you waited till 250 because you're now trying to force yourself into a supply candle here on the 5 minute, right? So price could easily, if you buy here at 250, 26,223s, push price above news, go to New York, and then literally just reject and fall. Like I've watched that happen a lot of times as well. It's not always going to go and run and take that high, okay? And so how do you play this level, okay? And that's what I'm going to go over here now. I'm going to bring that window over here really quick. Okay, so when I'm playing the higher time frame position, now a lot of times this is going to happen in the first 15 minutes of an hour and the last 15 minutes of an hour. You'll hear me redundantly say those same things because that's when price moves, right? The algorithmic price times supply demand is really going to continue to print a pattern that happens over and over and over. Now, the difference in FOMC, right? Like I said, you most likely if you're new, this has dragged you out and you've probably lost most of your ammo. If you've been doing this a while, you could just be exhausted already. Like you're just exhausted waiting, and you already know you have to wait to that second half of the day for the news release to give you something. So one thing I will say is if that news would have came out and didn't have like these equal lows, so like for example, when I'm looking at that 5 minute, I had a good feeling that, like this is what I didn't want to happen and it didn't. So that's kind of like this is exactly what I wanted to happen was price delivered the liquidity, giving us equal lows. I thought price would potentially go up and take the high there and then come back and rip 26,200, low of day, 26,165 and lower, right? But what they did first was, as they set up the liquidity, they already had underlying liquidity here. And so what they did was they ended up pushing that price right above New York open, right? So you'd like to sell in bearish conditions above New York opening price. And that was the sign for me, like, oh, okay, they're getting ready to destroy this price. Now, what I used to do is I used to try to force myself into this trade. And let me show you what that means. So the 5 minute right here, you have 1033, or excuse me, the 1 minute right here, you have 1033 to 1034, then 1034 to 1035, and then you have 1035 to 1036 is the capitulation candle. Now, most traders, if they're not watching a smaller time frame or understanding 5 minute location, their entries are going to be um, somewhere close to the breakout. So like somewhere like that is where they're going to be. Make sure it shows up on both here real quick. It's going to be somewhere as price is already falling under point of interest and not framed up with edge. Okay. And so like most of the time they're going to sell that position here. And that's if they get filled because that candle in 1 minute fell, right? About 120 handles. Okay. And so most people, the good ones the really good ones, I believe, are going to get their trades up here at that New York Open, setting edge here or here, like on this high. Um, Most traders are going to get this one, right? The 26,230s, like 220s area. And then the people who I believe, are just kind of like trying to force anything, they're going to get it after the breakout at the 26,200 level. Now, they're still going to make a profit on this trade, right? It's just way more risky and way more aggressive and less likely for you to get filled in a position like this. But I'm just showing you guys this is where people are going to be playing, okay? Now, the one thing I love about a setup like this is it's that mindset, like I always talk about, right? Capitulation bounce is a beautiful setup because of why. Well, let's kind of draw this out over here. You know, individuals have basically been playing, right? Price spikes up and falls very quickly. So let's think about the thought process, okay? Falls very quickly. You have a short position here, right? And prices has went down. Now let me show you this. What happens to most people? Let's say they have a risk like this, they had, whatever the number could be, but price is in their favor. Now, when price starts to hit a level and then go against them, right? At that same time, people start getting weak-handed as price starts to go against them and they start to lose more and more and more and more. But what they don't realize why this is happening is because we're in a bullish market, right? And so the reason why capitulation bounce play is a little bit easier of a play to set up on an FOMC or a news release at like a 7:30 a.m. is because of the fact that shorts will cover so fast, especially the individuals who play the breakouts or play lower end of this type of setup, that it's going to send the price back up very quickly. Okay. And when you're looking at like a higher time frame, you want to use your daily open as a gauge because if you're not like I'm not showing it here, but like when you're showing the daily bar, like if you're looking at the daily bar at the same time like I do when I'm looking at the middle screen and studying the 5 and the 1 minute here, you're wanting to kind of understand where high and low is on the daily, right? Because you want to be selling or buying low and selling high, right? Essentially, most people started selling here, right? And if they sold below daily, that's essentially wrong, right? Not saying anything's wrong or right, but it's less likely from watching so many charts that, you're going to be in that type of position to um for this to play out, not get to recover. Okay. Now the difference is as well, when you're trying to identify where a short's going to cover and you're thinking buy low, sell high, you want to be buying in a position more down in here, right? Because this essentially would be, high for right now, and this essentially would be low, right? And so the reason why I like these capitulation bounce plays again is because of the fact that um, they have a really good nuance that happens. Now, something that's going to happen very quickly that's really hard to see, but just so you guys have an idea, is you want to start thinking in supply demand. So as soon as this price sells off, what do you think happened to these individuals that were inside this buys here? Well, if they didn't press, like for example, they're sitting there in a position like this, like they think price is going to go up, they put their risk here, right? Now they're thinking, oh, well, I want this to deliver, and then what happens to them? Price just drains them, okay? So that's lots of people getting stopped out immediately, right? And so what happens is some people will play a smaller position or they'll use less volume in that type of trade and they'll hold that drawdown. Some people have the capital to do it, right? And so what you're seeing here is as soon as that drop happens and forms like this, immediately right above it, like right here, or like right above that this wick here, there's going to be stop losses placed in that area. Okay. Just like there were stop losses placed from that New York first run up, people took profits and then people came in and tried to short the market and left their stop losses in this area. So by knowing that, here's two things that can happen. And this is why I say um the don't play the oh, why did it do that? Don't play the inversion plays or don't play after price has moved through the 4 phases, right? Because there's one other thing I want to show you guys. I showed you guys overbought, oversold, but there's also another diagram I want to show you because the market moves in 4 phases, okay? And like I said, you guys can get this diagram anywhere online pretty much. Okay, so in Wyckoff, right, price will capitulate, and it has four phases: accumulation, markup, distribution, markdown. Okay. So when price is accumulating, like you're seeing here, right? Price is starting to accumulate. Marking up is when price starts to make body closures of higher high, higher low, higher high, higher low, and they're not breaking those demand bodies and essentially continually making their way up. So when you look at this, okay, the reason why I say don't play this area late again, oh, it thinks I'm doing the same thing, is because if you play at that MOC, right? MOC is 1450 here, so 2:50 p.m. Central Time Zone is when that release comes out. What'll happen sometimes to individuals is they want to take that liquidity, right, above the 26,285s. But what'll happen is price will come into that supply, right? So like let's say you entered right here at 250, right? And then you start to see price move in your favor. It doesn't always go and take that liquidity, okay? And so this is why you really want to be locked in on what I'm going to show you on the entry strategy down here, because if you take it way above, like I said, there's four phases, right? This is the accumulation phase, okay? So this is the accumulation phase on that 1 minute. This is the markup phase, right? And as you see, you're going to jump the creek or you're going to break the structure or take the liquidity. A lot of the times where I play my positions to are going to be back to point of interest and back to supply on a day like this. Okay. And reason being is because if you frame up a move, right? Let's say you even, like I was looking in here and I'm going to go over the move. Let's say you even took it a little later around 205 and you had a risk like somewhere in here for like 20 handles and you're trying to get above those highs and it didn't deliver, well, then you're going to be pissed because it's going to fall back against you, right? And so a lot of the times what I like to do is I like to target, when you're looking left here, I like to target point of interest, supply candle, and the supply candle, because that's still going to give you a favorable R&R, right? That's a 1 to 7 risk reward, which is, pretty good. But how I look to play this type of position, once you've been doing this for a while and you have an understanding of really what's going on, is you want to see a 5 minute sign of strength. Okay, so like for me, what I like to wait for is you had at one point you didn't know anything was going to happen, and then this was going to be at 140 to 145. It was still bearish. Now 145 to 150, and guys, I say this redundantly, do I not? Price likes to move in the first 15 minutes of the hour and the last 15 minutes of the hour. So now when you come in here and you're looking for that accumulation, right, 145 into that 2 p.m. time, you have to be able to figure out how to get your entry inside of that 5 minute demand, which is a very small area right here. Because if you plot your position, I'm going to show you this. This is just from something I've done a long time, right? If you plot the 5 minute area, you're going to have the good 1 minute position, right? Now, if you're counting up from your risk to entry, right, that would have been quite a bit of an entry, right, to get. I don't like to do 34 points. I like to frame up around a 20 handle risk, okay? And so in this situation, right, price comes down and then it runs up here in the 1 minute. Now, if I get it when it's running up, you see how that moved my area, my location? And now when I put my risk, because I'm going to put my risk either here or under prior bar low, no matter what, it's going to come back and scare most traders out here at that 147 to 148. They get out and then price shoots against them or shoots the way that they intended and they want it. So what you have to really do is you have to be able to have discernment and really read this price, that when price comes back down right here, right? 147 into 148, that you have to take that entry as prices in 5 minute location inside demand. Okay. And that's really the hardest part, I would say, for someone new taking a trade like this, is you want to have done this when it's not so volatile, right? Because it's going to be very difficult when you first start. But the same thing is going to apply, right? Now, you also could wait, price goes up, comes back down and closes here at 2 o'clock, 205 to 210, you see a 5 minute sign of strength. Now, you could possibly place something in this area, but the stretch is way more. Like if you took this type of trade, it may have come and stopped you out because you had such a tight risk. And then you try to take this one as well. Like I said, it's just a situation to where you have wanted to play down in here, right? Even if you got it right in here, I would say, and then you were able to frame up a 20 handle risk, it's still not a bad position. Okay. So like if you used prior bar low, that's 40 points, way too much, right? And then to me, this is about a pretty, good risk in that situation. But like I said, if you're gonna play this type of setup, you want to focus on no matter where you take that 1 minute entry, that when you see when I look left, right? When I go left, that you're getting your entry inside the 5 minute demand 26,080 level. Okay. Now, what that makes it better for you for, right, is because when price shoots up, I mean, you're looking at, um, how I frame this one up is going to be on that same side. So let's say you got like right in here, risk could have been right here at prior bar. So like that would have been about 26. You could use the bodies, right? Like the bodies right here for the 20. And then you're shooting anywhere above, right? Daily open and the initial balance where they took the double bottom, right? So if you can get back to point of interest daily open, just in that setup alone, you're looking at a 1 to 5. So price shoots up in your favor, and then what you could do is start to partial out, depending on if you had one contract or two, or if you only had one, then maybe that's all you wanted for the day. That's cool. But now how you can manage that trade is if you did have two contracts, right, in this situation, essentially what you can do is partial out of one when price comes up and delivers at 26,200 or anywhere below above daily. Or like what I do personally is when I get in an entry like this and price presents down candles in an uptrending market like this candle here, I'll take one of the contracts and just shift it up here and go break even on the remainder. Okay. And so because you chose to have the right location, right, price never comes back and you've got that break even trade right here, and price never comes back and takes that area and then comes back and stays and then makes a new high here showing signs of strength. And you're able to, at that point, now, after this 5 minute, 205 to 210, you're able to take that risk. As soon as this price closes higher again on that 5 minute, in my eyes, I can take that risk and trail it to right here. Now, it's not very much, but it's trailing it about from 26,285 up to 25,000, let's just say 215. So it's about 20, 30 handles that you're securing, and you've already secured a partial when you had moved your first risk, okay? And so now price kind of chops around now, supply demand, right? It's created a new level of demand in this situation, right? So like going into the end of the day, right? And so people just don't believe in this stuff, but I promise you this stuff is real, okay? So now you have a new level of demand because of how the bodies are closing in the candles, and you've trailed risk from that area to this area. Okay. Now price does its own thing. There's no way you're going to be able to just really play too much price in here, especially the way it was chopping around and doing crazy stuff. But you can feel a lot better when you know you have the management secured. Now, what is your target? Your target is to get above here, right? Above New York Open, right? And then get back above that all-time high area for a final target of what we talked about in pre-market, which was 26,350. And so you don't really know at MOC unless you're really, you've been reading price quite a bit. But for me, like I said, I can kind of see here that like there's certain little subtle things that are happening inside that 5 minute demand right in this area. Like you're getting a 5 minute close higher high, right? So you've got higher high, higher low, body close higher, right? Then if you look at the 1 minute price, right, on this right side here, right, price was coming down like this, and then it shifts in price delivery and bodies close higher here. Comes back to daily open, right? That could have been a really good buy area. Now, guys, look at the timing on this, right? First 15, last 15 minutes of an hour. So this is right at 245, right? You're getting another great setup to take that to the upside. Right now, like I said, that's if you missed this move, this was the next best one. Why is this one better than trying to take a breakout MOC trade? Because you have edge, right? You're at daily open. You have about a 30 handle risk there. And if you're using bodies, what did you have? Or like prior bar right here, 20 handle risk, right? Because you want to be in control of what you risk. You never know how much you can actually profit, especially if you're trailing risk and not just taking yourself out of moves. Now, to get from this area, right, 20 handles to getting just above that area there, you're already at a 1 to 3, just breaking the first 5 minute area. So just breaking this area here, you're already at a 1 to 3, if you can see that. But getting above that next area, so above New York and into the supply that we talked about, because what if you don't get price to break above New York and go higher, right? You're still securing over a 1 to 4, right? And then let's say if you're looking for that news drop where most people put their risk here, that I would say, some people like on Top Step, they were putting their risk at 26,300s. You're attacking that area for over almost like a 1 to 6. Now, if you're going to go for that, New York high, right, and that high of day, right, you're looking at like a 1 to 7 trade even from here. Okay. Now, the difference in why I say precision in this area is going to be a lot better and being able to read price and setting up edge is because now look at the difference in the ICT traders and the edge, right? The precision here, opposed to trying to take a trade at 250, right? And price is already breaking out. If you look at it, could come down easily 45 handles. Price could easily come down 65 handles back into where? Back into demand. So like when you study this price enough, you start to realize that individuals are putting their these 1 minute players that are playing, like I play 1 minute too, but I trust edge, okay? But these 100 tick players and 500 tick players and people who don't understand probabilities, what they're doing is they're putting people in a position to get blasted, right? Because unless they have an edge of even, if they put their edge 20 handles here, right? That's too tight. Most times it's going to stop you out and go, as you can see right here, right? So you want to be able to have a shift in price delivery and look at it from a line graph perspective, okay? That's where you can really see, if you come in here and see this, right? That's a shift in price delivery, okay? So as price comes back down or buying below daily open in bullish conditions, right? You're going to have a better edge on that than trying to play the breakout setup, okay? And so I've given you guys two ideas, right? If you're still new, I would say this one's going to be a little bit harder, right? Because it's going to scare you out of the trade, but that's the one that personally I like the most at this point of my career. But the safer one, I would say, which is, still really good, is to see the, and I'll show it from the replay mode here real quick. Start new. Is to see this right here on a 5 minute, right? Because it's clearly going back into the demand here, okay? Now, what most people do here is they start to buy this position on the breakout, right? They're starting to try to buy it, buy it, buy it. They're not letting price, observe the math to do the opposite. You want to be buying the market when it's crashing and selling it when it's taking off, right? So like that's something I like to think about is like if I'm buying it and price is already moving up, I'm probably too late, okay? And so looking at this, like I said, that was my sign to get ready, right? Seeing this right here, right? When that price pumped up and made that 5 minute high. So from 235 to 240, that gave me the sign to start, and that shift in price delivery, as you guys can see right here on that 1 minute, right? Like we talked about, goes higher than that previous bar. That gives you the sign to start shaping up this low and using daily open as like your entry strategy. Okay. And so right after that, price explodes right through that area. And then MOC, this is when, you see the report come out, they deliver that liquidity, it starts to go higher, kind of has a slight pullback going into that 3 p.m. Central Time Zone. And then going into 310, you just see price explode up another 100 handles, right? Because from 26,250s here up to here was 100 handles. And at that point, when you started to break through that New York high, I would say you'd probably want to start protecting that position depending on where you got in. So, for example, right, if you still had, a runner from here, right, and you had a 20 handle risk, right, from these bodies, you essentially, at this point, when price basically made this level here and then closed higher, as you guys can see that, like the body's closed higher, I've trailed all my risk up into this area here, okay? So that's going to secure you over a 1 to 7, regardless of what happens or if it comes down the last 10 minutes of like top step liquidation or whatever. Because as down candles get presented in an upside market, that's giving you edge to start securing the bag, okay? And so let's say hypothetically you took that second area that I talked about. All right, so let's say you waited, you wanted to be a little bit more patient, you kind of felt like, oh, okay, they're not going lower at this point, and you took this area here, right? So you came down, maybe you got it a little later than you wanted, right? But you're still always focused on 5-minute demand location, okay? Now that edge, right? That edge right here, this would have been too much for me. I wouldn't have wanted to risk that in that situation, right? But what I would have liked to do, like I said, is focus right here at daily open, then something more like this, and then I use that prior bar. So when I say prior bar, I'm talking about this candle here that showed me strength. Okay, so then price goes higher, comes back down. You see the strength right here, and then maybe you start to take it right in this area with your stop right here. Now, if you have that area and price goes in your favor, just like it does, right? So it goes from here up and then it never even comes back to like this area and takes that new high, essentially all you have to do with this setup is just trail the wrist to the bottom of this candle right here. All right, so when you get that type of setup and price presents what I always say, me and my good friend Tay are talking is pay yourself as the market makes money available, act on your edge without reservation or hesitation. Okay, so like when the price gives you this candle right here, next candle, and then the next candle closes higher on a 1 minute, 5-minute body, right? And it started taking. When you look at that supply area we talked about, the body of the 15 is closing higher than the previous bars and New York. That's pretty much telling me to go ahead and secure this low. And that way I don't have to, if price was to continue up to 26,600 or higher, then maybe I just keep trailing it as down candles present in an uptrending market. Okay. And so that way that kind of saves you if you think about it. So when this was like 304 to 305, price kind of shoots up again. Doesn't it give you a new down candle and a new body closure? So essentially what you can do, like I said, is um, you can move that to here, right? To this area here, right? And secure a little bit more on that trade as price is made more available to you. Now, I'm not going to move it from this area until I got the close, right? From 304 to 305, that body close, then I move it. Okay, because I gotta see the body closure on whatever execution window I'm looking at before I move the risk. Otherwise, if you were here and you seen price go in your favor immediately and then you moved it, you don't have anywhere to move it to, right? Like that's what, you know what I mean? Like you wouldn't have anywhere to move that price to. And then if you look here, this was 305 to 306, 306 to 307, 307 to 306 to 307, and then 308 to 309, and then they liquidate the price here. Okay. And so this is why I say trailing your risk in a situation like this as the market makes money available is going to help you secure more of the bag. So I hope that makes sense on the 5-minute, 1-minute entries here when it comes to, finding those. I know a lot of people they like to play the 1 minutes. So regardless if you're playing 15-5 on a normal day, I would say you can play a 15-5 setup and, find pretty good edge and not have to really go in there and like force your way into it. But on a situation like today, I mean, like if you're wanting to be as tight as you can and you want them to play your game and you don't want to play their game, you're gonna have to go in there and have to be able to read the small time price action stuff. So I just want to show this part on the small time frame, right? Because it's really helpful. Price starts to build up, and what you're looking for is body closures, right? Good body closure. Price comes down into demand, it's very small, comes up again, body closure, right? And then what does it do? Falls off, tricking people. They start selling breakouts on 100 ticks and stuff like that. Now, as soon as you have this candle here, as you can see on a line graph, right? Price comes back up and closes higher. This is where people freak out and they start to buy on the way up, right? Like I said, you want to be buying when the market's crashing, selling when the market's taking off. This is where it gets people trapped because they buy in a situation like this, right? Like in here and here, and then it pulls back on them, and that's where they place their risk because they don't have any idea of where to put their risk or to define edge and use probabilities in their favor. And so this is a beautiful setup, I think, honestly, compared to this one, because you're gonna have to be pretty experienced to take this one. But this one is pretty clear to see, right? That you got that body closure above. And I think you have a good amount of time to be able to reasonably come in here, use point of interest for a place of entry, also for places of exit, okay? And so you could come in here, you could evaluate that low and say 30 points. You could probably factor something into that, but I want them to play my game. So like I said, 20 using that body. So using that body low right here is going to give you that 20-point risk. And even if you're not going to get to the supply candle, just breaking, okay, just breaking this area here is going to present you um, a 1 to 3, a 1 to 3 R, okay? And getting up to and giving back above New York Open would give you about a 1 to 4, 1 to 5. So I hope that helps out when it comes to looking at these small time orders and being able to, be patient and defining the edge of what you're looking for. Because sometimes we can get really rushed, or sometimes we can, especially on an FOMC day, you can sit there and it can be very stagnant and you have to wait. But just remember that, on an FOMC day, if you're not familiar with it or you don't really know, then don't put yourself in a position to have to make something happen. Okay. But this is just for some people who, want an idea of, what to look for in FOMC. The main thing I love to see, like I said, is something like this. Okay. You're getting massive capitulation move where you got to understand at some point if these individuals are up 200, 300, 400 handles and like 15 minutes, 5 minute candle, they're going to start to cover that position at some point. Okay. And so let me look at this from a little bit higher time frame. Now, we'll see what happens tomorrow. There's a lot going on here. Another thing you can look at kind of help you out is going to be QQQ and SPY, right? So I'm not going to really go over SPY because that's like more on the ES side of things. But if you start to see that they didn't deliver the liquidity that we were looking for, which was the 629s, this if you line them up together, right? Let's line this up, okay? And then we'll use a 5 minute. If you line them up in the timing, you start seeing buyers step in at the 630s, right? On QQQ. At the same time, you're seeing the short covering on NQ, right? So for like option traders and stuff like that, it's essentially going to be the same thing, right? And you're looking for price to deliver back into supply, the 635. So I use this as a gauge to help me be able to identify, our, as a collective, our buyers stepping back into this marketplace. Okay. So yeah. So, like I said, I gave you guys two different options. If you played from the low end, how to manage it and somewhat how to play that second area way before MONC. Uh, because like I said, you're essentially playing a breakout trade here. You're basically playing what I first learned as a noob, which is a breakout test if you do this, right? So you want price to play into your hand. You want to play and think in probabilities, okay? So that being said, don't let Jerome Powell blow your accounts. Don't let him make you have a bad day or make you feel bad. Because tomorrow's another day and they're gonna print the same patterns again tomorrow, right? So let's look at really quick, just so since you guys are probably watching this right now, just like what we're kind of expecting for tomorrow. Take all this stuff off. We're still at all-time highs, right? And I would say since this wick was delivered, I could see them, they've been doing this overnight. They may deliver 26,400 overnight. This could be the high for a while, for a little while, just because we do have the gap that was created at the market open at 25,700. So we could see some capitulation that takes out this lightsaber. This is basically what this is a lightsaber trade or print here when you have a wick to the downside, a wick to the upside. So let them form, let them see, let's see what they do overnight. But going into, the end of the week, I could definitely see them and the end of this month. Let's look at that really quick. I could see some individuals start to take profit and this start to kind of fall out. But, you can't put it past them because they've just been going pretty crazy all month. So with that being said, I appreciate you guys watching. I hope that helps out with just understanding some of that capitulation bounce. And, some of the things we touched on was, if you're having trouble with those entries is defining your entry from the perspective excuse me, what was I trying to say? So defining your entry from the first 15 minutes of the hour, last 15 minutes of the hour, and also um, just being patient and having edge, okay, and just really defining your edge when it comes to your probabilities. So thank you guys for watching and have a good rest of your night.